Beautiful. Guys, welcome to another video in the advanced series. I'm excited about this one. You know me, I'm always excited. I'm always excited to be trading, talking about trading, anything to do with trading. I'm excited for. But for this one, guys, indices, index funds, indices. Some of you are familiar with indices. Some of you may have never heard of indices before. A lot of investors, people who work on Wall Street, they look at the average of all of the stocks or companies to really just gauge the overall consensus of where we are in the economy. You know, when your father's like, or your mother, your father are like, hey, just put $50 into your Roth IRA, if you just put this amount of money in the S&P 500 every single month, you'll have $1 million when you're older, right? And it's like, okay, great, good. But what exactly is that? What exactly am I putting my money into? And we're going to break that down in this video. It is going to be somewhat lengthy. I'm going to try to keep it short as always. I like to keep videos short because the longer the video, the more there is to digest, and it's better to just keep it simple, keep it concise. And so let's go ahead and dive right into indices. So what are indices or indexes? Okay. They are groups of assets or securities. They provide a way to track and evaluate the overall performance of a particular segment of the financial markets. Indices are commonly used in trading and investing for various purposes, including benchmarking, portfolio management, and as underlying assets for derivative products like futures and options. If you've ever heard of futures trading, the most popular futures asset is the NASDAQ 100, the S&P 500, and the Dow Jones. Technically they're called the many futures. They're called many's, but anyway, we'll keep going. So it measures the performance of a group of assets, right? A basket of assets, okay, or securities. Now, indices are commonly used in trading and investing for various purposes, okay? And I'm reading this one more time, okay? Portfolio management, Fidelity, Charles and Schwab, retirement accounts, okay? Benchmarking, okay? Whoops. Benchmarking, let's see. Is the practice of comparing business processes and performance metrics to industry bests and best practices from other companies. Okay. Interesting. Actually, I put that in there, and I'm gonna be honest, I never even knew what that meant. Benchmarking. That's a new one for me. It's a new one for me. Okay. Let's keep going. Okay. Stock market gurus monitor indexes to get a feel of the market's overall performance. So that would be what benchmarking. Benchmarking is just a type of monitor or indicator to help identify the type of purposes in indices trading. Okay, so the overall performance. That's what we're looking at when we're looking at indices. The overall performance of the entire U.S. economy. Every single big corporation that you could possibly think of is inside of an index. It is part of that basket. So it's showing the overall performance, okay? Now, these are the types of indexes, and there's a lot of these. So definitely take notes. Please take notes. Write these down. I guarantee you've never even heard of these before. These first three you've heard of, possibly, but the next ones you've probably never heard of before. Okay, so we got the S&P 500. Okay, the S&P 500 is a stock market index that measures the performance of 500 of the largest companies listed on the stock exchange in the United States. Okay, it is a widely followed benchmark for U.S. stock market. Benchmark indicator. Makes sense now, right? The Dow Jones Industrial Average is often referred to as the Dow. This index tracks the performance of the 30 largest publicly owned companies in the United States. We're talking Apple, Amazon, Microsoft, NVIDIA. We're talking, you know, the big boys, right? Tesla. Gosh, what else? God, I don't even know if Walmart's part of that anymore, but they're if you looked it up, the top 30 largest publicly owned companies, you would see that there's quite a few big ones that you recognize. So that's the Dow Jones, okay? It's the average of 30 large companies. The S&P is 500 large companies, and then the NASDAQ Composite Index, okay, is all the companies listed on the NASDAQ stock exchange, known for its technology and internet-related companies. They also have a NASDAQ 100 compository, which is made up of the largest 100 tech stocks in America. All right. So these are your three basic and most prominent indices that you can trade and that you can monitor every single day, every single month, year, and decade. Now, let's get into some more interesting index funds that aren't as widely known, that are very good indicators for economic health, and you can trade these bad boys as well. So the FTSE 100 is the Financial Times Stock Exchange, okay? It's the largest 100 companies on the London Stock Exchange, right? It represents the performance of the UK's leading companies. It gives you a good gauge of how London is doing, right? The FTSE 100. The DAX, man. Deutsche Aktien Index. Aktien? Deutsche Aktien Index. Something like that. I'm close. I'm learning my German. The DAX is the top 30 largest companies in the Frankfurt Stock Exchange, Germany. Right? Big Germany. Love Germany. Love Germany so much. I don't know how to pronounce that either. The Nikkei 225. Nikkei. I don't know how to pronounce that. That one is the Japanese stock market index. Okay. This tracks the performance of the 225 largest publicly owned companies listed on the Tokyo Stock Exchange. So now we're getting into some other countries, right? These are America's, right? And then these are, this is London, this is Germany, and this is Japan's. Okay. We got the Hang Seng Index, which is the Hong Kong, representing the most liquid companies on that exchange. The CAC 40 is the France, the France 40 largest companies, okay, in Paris. The Russell 2000 is the 2000 small cap companies here in the United States, used as a barometer, okay, of smaller companies. So the Russell 2000, right? That's a basket of 2000 small cap stocks. You know, we're talking like DoorDash is, I don't know how profitable DoorDash is, but I would imagine DoorDash is one of those small cap stocks. You know, True Value, Ace Hardware, you know, Jimmy John's. God, what else, man? What else? What are some other small cap, very publicly owned, you know, chains? Anything that's a chain that you can think of, like a Dillard's or a Dick's Sporting Goods, those are most likely going to be within the 2000 small caps, even possibly the S&P 500, right? Those kind of stores. So the Russell 2000, okay? The VIX, the VIX, the volatility index, this is not an index that you can really trade. This is an index that gives a volatility measure of fear. It's a fear gauge, right? How volatile is the market? How much trading is in the market at a given time period? So the VIX, and I'm actually we're gonna go over every single one, okay? So trading indices is widely popular due to the amount of volatility involved in the markets. Before trading indices, it is highly recommended to have experience in trading and emotional intelligence behaviors. It can be very profitable and is a great market to master. 1022 will go over indices frequently because it provides information about economic sentiment and performance. Check this one out, okay? This is the S&P 500 over the weekly time frame. So you have 1989 all the way down here. We have 2024 right here, okay? And you can see that the stock market is always performing very well. That's the whole idea, right? Is decade after decade, you will always have growth. I don't think there's not a single decade, okay, there's not really a single decade without growth in there. Look at this though. 2001, right? The market dropped for, let's see. The market dropped for 3 years, rebounded a little bit, right? It rebounded in 2005. And then for another 7 years, it went up. And then it had another decline for about 2 years. And then we haven't had that big of a decline until COVID. COVID was a fast, sharp decline. And then it just kept shooting up. And then at the beginning of 2022, we had a nice decline. And then into 2023, later into 2023, we're starting to see the increase again in the stock market. So we're probably going to continue to see stocks move higher until something happens again, right? Something like a war, something like a recession, something like a global crisis, presidential election, COVID, anything that could rattle the markets. There's always something that comes along. Here's the NASDAQ. Little bit of a different looking chart in terms of volatility, right? You see that it's a large move up and a fast move downward. And actually, if you look at the time frame difference, this was before 2000 where it peaked, and the S&P didn't peak. The S&P kind of started dropping around 2001, whereas the NASDAQ had already dropped significantly by 2001. So it was kind of like already leading the downtrend there, but still on an absolute tear to the upside, the NASDAQ. And then this is the Dow Jones Industrial Average, the top 30 largest publicly traded stocks. Here in 2001, now what's interesting about the top 30, right, is the reason why you have such a much larger decline here and here is because these are 100 and 500 companies. This is only 30 companies. So those 30 companies were probably still performing very well. And so there's not as much volatility on the Dow, but it has the same exact pattern, just a little bit different price action. So these markets gradually increase decade after decade. Some years there will be negative growth, but like every market, corrections are a healthy part of the overall market. Long-term investors dollar cost average into index markets, knowing over the long run they will experience gains on their investment. Okay. During times of uncertainty and fear of economic downfall, investors will sell their shares and the index markets will retrace for a period of time until economic optimism returns. On the smaller time frames, day trading indices can be extremely challenging. Before upward moves occur, volatility and extreme volume enters the market to intimidate the average trader. With lots of time and practice, indexes are a wonderful instrument to trade. Not only will there be opportunities for huge moves, but the market leaves clues giving insight into future price points and targets. Fuck, beautiful. Okay, indices. Indices. I knew that oil trade was going to absolutely bang. That's so funny. All right, boom. Let's go to that weekly chart, you guys. Let's check it out. Okay, this is what we were looking at. And as you can see here, okay, we have our uptrend here on the NASDAQ. We're sitting here at 2022. So as you can see, we had about a 36% correction from 2021, or I'm sorry, the beginning of 2022 to the end of 2023, we had a correction. Now at the beginning of 2023, all the way up to now, 2024, we've had a nice, beautiful move to the upside of 66%. That's pretty beautiful, guys. So that's NASDAQ, right? We're looking at the NASDAQ. Now on the weekly time frame, each week you can see is significantly bullish. You have your weeks of bearishness where you have like 1, 2, 3, you have one, you have one, you have one. You have very scattered bearish weeks within the uptrend, right? And even this correction here was 10%. That's pretty massive, but within that 10%, you have a lot of choppiness. and then you just have a straight uptrend of bullish weeks, consecutive weeks. You have one down week, and then you have a consecutive bullish continuation again. And here we are seeing our first bearish week. Okay. So, and it's actually the first that we had a bearish week at the beginning of the year, and then it's been bullish since then. And then here's our bearish week in February. So we have our first bearish week in February. November didn't have a single bearish week. December had one bearish week, technically didn't have bearish week. So some months are straight bullish and some have a bearish week or an entire month or two with bearishness. That's kind of the repetition pattern. Now, when you have periods like this where the stock market's just selling, I mean, there's a lot of bearish weekly candles within this trend. And during that time period, when you see large weekly candles, you're kind of just looking for sells. But other than that, you're looking for buys. If we go down to the daily time frame, we can kind of see it a little bit better here. Now, that daily time frame, you're kind of just looking for those retracements, right? So boom, this low to this high didn't even get a 38% retracement. Market went up again. We draw our fib from high to low, from low to high. I apologize. We had a 618 retracement on the daily time frame. So we have that 618 retracement and then the continuation. So here's our new low. Okay, we take that low, we draw it upward. Looks like we had a 38% retracement here before going higher. Okay, now we see that we have our daily fib. We take our fib from low to high. We are currently sitting right below the 50%. Okay, so if we go to that 1 hour time frame and we extend outward and we see our fib here, and we're gonna just pull that in just a little bit there. Beautiful. Oops, there we go. Oh, that's not correct anymore. There we go. Okay, there we go. Boom. So now we zoom in on that hour time frame, right? Look how volatile it is on the hourly compared to the daily, right? Like that daily time frame, the candles are pretty bullish, the weekly is pretty bullish, but then you hop into the 1 hour and you have all this choppiness, all this chop, right? So fascinatingly, this is fascinating. Pay attention to this. With indices, they're very fast, volatile moves. I mean, we're talking like 9 o'clock to 10 o'clock could be very volatile. When news hits, you could have a 1% move, which is 231 pips on a 0.01 lot size. On a 0.01 lot size, that is $231. Like on the smallest lot size, that is a 234 pip move that just happened, right? In a normal day with no news, this market only moves 76 pips, right? So that's only $76. On Friday, it was $158 on a 0.01. So there's extreme volatility in this market, you guys. And this is just one index. Okay. Now notice this. We have our Fibonacci, remember on the daily time frame, we were looking at our lows and our highs, which is what we practice in our series, right? In the intermediate and beginner. We're sitting underneath the 50. Notice price action on the 1 hour, how price action comes down into the 50%, drives by 68 points, and then drives all the way back upward 137 points to fill the imbalance to then continue to decline below the 50. Now we're looking at this 618 target. We're looking at the 618 for a possible buy position into tomorrow. Now the market could keep just tanking. It could keep absolutely melting, and then we'd go back on the daily time frame and we'd reevaluate where that retracement's going to come down into, which could possibly be an 80% retracement, or we can take our fib, right, and draw it to here and say, okay, we haven't even reached a 38.2% yet. Because technically, this could be considered a retracement, but this high wasn't cleared here, right? So technically speaking, we'd want to take it from here to here, and we'd want to wait for another 38% retracement down in here. Or we can, like I said, and actually, let me watch this. Okay, 382, okay, from this leg to that leg is 38.2. 80%, right? So that 38.2 is now just the 80%. So that's what we're looking for at indexes. Let's go ahead and look at the S&P 500. Beautiful. Same exact down move, same exact downtrending motion on the S&P. Okay. On the daily time frame, same exact movement on the uptrend. We're looking for kind of the same thing, guys, just that Fibonacci retracement. The S&P trades a little bit different than NASDAQ. NASDAQ's a lot more volatile. So if we look at our retracement here, we had a 50% retracement. And then we had let's see here. We had kind of the similar pattern here. We had a 618 retracement on that move on the daily. And then we go ahead and pull our fib from there to there. We had a 38% retracement. And right now, we're currently sitting below the 50 as well. So like I said, we're kind of waiting to see what happens with the S&P, but we're going to probably continue to look for buys, okay? Let's check out the FTSE. Beautiful. Okay. So check this one out, guys. Is that all they have? Is back to, they've got to have one that goes further. Say they have to have one that goes further back. There we go. Okay, beautiful. Check this one out, guys. So this is the 100. Remember, this is the London exchange, okay? FTSE, top 100 stocks in London. As you can see, just kind of like the stock market in a big uptrend. Look at the volatility. Look at that volatility in 2000. Similar to the decline with the S&P and the NASDAQ. It's very, very similar pattern, but a lot more volatile. I mean, look at that volatility. That is a massive drop off, guys. But still bullish, right? So on the FTSE, it's a lot more choppy. I mean, we're talking choppy boy. I mean, this is unbelievably choppy. We have a very large resistance right now at 7,600. 7,660 area. We have a very large resistance where price is just continuing to trade below. And just like we saw the last 2 days on the stock market we just looked at be bearish, these are also pretty bearish. So we can see that sharp decline to the downside. Very, very similar to the indices we just reviewed, which is very fascinating. So that's the FTSE 100. Okay, we have our Russell, and this is the futures chart of the Russell. Also there's futures trading. So your futures chart lags behind the actual charts, which is kind of fascinating. But your futures is for aftermarket trading. So after 5 o'clock, you can trade your futures, okay? So that's an ETF. This is the Russell ETF. This is the index. Fuck it, dude. Why don't they just list it normally? I don't understand. Jesus, there it is. All right, here we go. Now, here's the weekly time frame on the Russell. This is the Russell 2000, the 2000 small cap companies. Okay. Very similar to very similar to the stock market trend. A little less movement, not nearly as much growth and volatility. So I do want to go over the pattern in 2022. Remember the decline that we saw on indices, right? The NASDAQ dropped about 33%, 36%. The Russell went ahead and dropped 32% total. Okay. And fascinatingly enough, right, these highs right here have not really been cleared significantly like on NASDAQ. So we're seeing a little bit more consolidation in this range. Like on the NASDAQ, if we go look back at the NASDAQ, right? Think about when the uptrend started in October, right? The Russell has only gone 26%. The Russell has only gone up 26%. The NASDAQ from October has gone up 70%. That's a huge difference, you guys. Huge difference. So when we're looking at this one, it's the 2000 companies, right? So you think about this. The basket of 2000 companies is not nearly as good a performance indicator. And that is why it's not it's not going up as much as the other indexes, because it's 2000 subcaps. Not every company is performing at its best, but it's still doing good enough to be in an uptrend. Okay. So within the last hour, right, we were at highs on the Russell, and it just absolutely dropped. And it's only gone 72 points, so not nearly as significant as a drop. But this Russell is really fun pair to look at. So I highly recommend, if you're going to trade indices, to check out the Russell index. Let's go check out the CAC, baby. The CAC. Do they have a... Yeah, this is it. Okay. Let's check out the CAC. Let's go. All right, check this one out, guys. So remember, very similar to the FTSE and similar pattern to the NASDAQ, S&P, Dow Jones, but so much more volatile. I mean, just like the London exchange we were looking at, I mean, that is a drop. You know what I mean? And same with the 2008 housing recession that we had in 2008. I mean, an absolute dump fest of price just melting. And then we have our continuation in the uptrend. COVID absolutely took this for a spin. What's funny about this is it was 1, 2, 3, 4. It lasted for 4 weeks. That's it. It lasted for 4 weeks, and then it continued upward. Now check this one out. The 2022, now this is cool stuff right here, you guys. So the beginning of 2022, okay, remember, same exact move, the drop downward, okay, and then check it out, massive move to the upside, just like NASDAQ, went 34.73%. But then we had a nice little dip here. In the beginning of, in the middle of 2023, we had a nice dip from April 23rd to October 2023. So in September of 2022, the stock market was still falling, right? And in August of 2023, we had that decline, and then it peaked at October 2023, which I guess you could say, yep, same exact time frame. But gosh, does this chart just look so different? So let's go ahead and check out that hour time frame. Boom. Just like the NASDAQ, we have the same drop here. We have the same exact drop from news at 8:30. Now the time frame is very different. Is it 2 o'clock? It is 2 o'clock. Yep. Now this pair has only dropped 80 points. Okay. Boom. Let's check out the Nikkei, baby. The Nikkei. Okay, here we are on the weekly time frame on the Nikkei. Wow, that's some wild shit right there. Boom. Absolutely crazy. So the Japanese economy is doing phenomenal right now. I mean, the Japanese economy is doing very, very well, although their interest rates are super low. Notice that we just had a large trend downward all the way down. And then during the 2008 recession, it dropped, but it did a lot better in the earlier stage of 2000 to 2008. It had a swing down, but then a nice recovery. And then ever since then, it's been on an uptrend. You have COVID here. You have the COVID drop here. You have the 2022. Now, fascinating about Japan is not nearly as bad of a decline in 2022. When we had that drop off in 2022, it only went 16%, and consolidated and recovered very nicely. Very, very nicely. And now from there, it's up 25%. And then if we go down to the 1 hour, let's go down to the 1 hour. Okay, here's 8 o'clock right here when all the indices tanked. We're down 1%. We're only down 1% on the Nikkei. So guys, notice the difference in every single index fund. They're all very, very different. That's really I just wanted to go over with indices is there's a lot of indices to trade and they're very, very profitable. They're very profitable, but you can lose a lot of money if you don't trade them correctly. I've been there. I've done it. They're super volatile, like super, super volatile. And yeah, so that's going to do it for indices. I hope you guys enjoyed the video. And if you have any questions, reach out and we'll hop on a one-on-one and go over some more indices. Thanks for joining, guys. Take care.